Most people think a bigger house is the ultimate sign you've made it. It's the physical proof of success, the American dream in brick and mortar. But what if I told you that this dream is actually a financial illusion, an illusion that could be quietly costing you over $1 million? In this video, we're going to shatter that illusion. We'll break down the real math that most people never do and share the story of a family whose dream home upgrade turned into a total financial nightmare. More importantly, we'll show you how to avoid making the same mistake, a mistake that is the #1 wealth killer for the middle class. This isn't about shamming anyone for wanting a nice place to live. It's about revealing the hidden blueprint for wealth destruction that's built right into the idea of moving on up. To see how this all plays out, let me tell you a story about a family we'll call the Millers. Their story is a perfect example of this wealth-killing trap, and it's based on something that happens every single day. The Millers were doing everything right, or so they thought. They saved their money, they had good jobs, and back in the early 2000s they bought a practical starter home for $185,000. It wasn't a mansion, but it was a smart financial move. The mortgage was totally manageable, which allowed them to live comfortably and still invest for the future. For years, they were on the perfect track, building equity and watching their net worth grow. But then that familiar itch started. Their careers took off, their income went up, and they started feeling the pull for something bigger. They saw friends and colleagues upgrading to more impressive homes in fancier neighborhoods, and that starter home, the one they used to be so proud of, started to feel a little small, a little cramped. It felt like a symbol of who they used to be, not who they were now. Their decision to go house hunting was driven by that classic toxic cocktail of emotion and social pressure. It was about status. A luxury home is seen as a trophy that signals your success to the world. For the Millers, that 4-bedroom new build with a 2-car garage and a gourmet kitchen wasn't just about more space, it was about validating all their hard work. So they took the plunge. They sold their starter home and rolled the equity into a down payment on a beautiful, spacious new house. The price tag was way higher, and so was the mortgage. On paper, it seemed fine. Their bigger salaries could handle the bigger payment. They felt that surge of pride as they moved in. They had finally arrived. But that illusion of wealth started to crack almost immediately. The new mortgage payment was just the beginning. Their property taxes, they more than doubled. Their homeowner's insurance premiums shot up. All those costs get bundled into your escrow payment, so suddenly their monthly bill was way higher than they had budgeted for. Then came the other costs. The bigger house had a huge lawn that needed constant landscaping. The utility bills to heat and cool all that extra space were shocking. And a big new house comes with unspoken pressure, the pressure to fill it. Their old furniture looked tiny and out of place. That big patio looked sad and empty without a new grill and outdoor furniture. This is a classic psychological trap called lifestyle inflation. Once you commit to a certain status symbol, like a big house, you feel this pressure to make everything else in your life match that image. The sensible car gets traded for a luxury SUV. Budget-friendly vacations get swapped for expensive resorts. This secondary spending can explode, increasing by 20 to 50% and completely wrecking a financial plan. For the Millers, the dream house wasn't a dream at all. It was a financial black hole that sucked money from every corner of their lives. Okay, let's step away from the story and look at the cold, hard math. This is the part most people refuse to do, and it's what separates the illusion of wealth from the reality. The damage isn't just higher bills, it's the total destruction of your ability to build actual liquid wealth. Let's use the real data from the case study the Millers' story is based on. By 2010, a few years after moving in, their big house had appreciated to about $310,000. On the surface, that sounds great, right? But here, the devastating part, because their mortgage was so huge, they still owed $502,000 on the house. They were massively underwater with huge negative equity. Now let's run the alternate scenario. What if the Millers had just stayed in their modest $185,000 starter home? Let's say the annual difference in cost between the two houses, mortgage, taxes, insurance, utilities, all of it was about $25,000 per year. If they had taken that $25,000 a year and just invested it in a simple index fund earning an average 8% return, the results are mind-blowing. Over 20 years, that investment would have grown to over $1 million. And that's not all. By staying in the smaller home, they would have paid it off completely. So instead of being hundreds of thousands of dollars in debt on a big house, they would own a smaller home free and clear, plus have a liquid investment portfolio of over $1 million. Let that sink in. The choice to buy the bigger house didn't just cost them more each month. It costs them a paid-off home and $1 million in the bank. The people who make this trade end up with maybe a few $100,000 in home equity but zero liquid savings because they spent the difference on empty space and stuff to fill it. This is the definition of being house rich and cash poor, a situation that feels wealthy but is actually incredibly fragile. This is a perfect example of wealth conversion, not wealth building. You take your future earnings and your most powerful tool, time for your money to compound, and you convert it into an illiquid, expensive lifestyle asset. And we haven't even mentioned the silent killer, transaction costs. Every time you buy and sell a house, you lose around 8 to 10% of the home's value to commissions, closing costs, and other fees. When you keep upgrading, you keep resetting your mortgage clock. You go from being 5 years into a 30-year loan all the way back to year one of a new, bigger loan. And in those early years, almost all of your payment is just going to interest. You're stuck on a treadmill, paying the bank instead of paying yourself. If this is starting to make you rethink everything you thought you knew about real estate, do me a favor and hit that like button. It tells the algorithm that this is a conversation we all need to be having. And if you want to keep challenging the financial myths that hold people back, make sure you're subscribed. So why do so many smart people fall into this trap? It goes way beyond the spreadsheets. It's about psychology. The decision to buy a big house is almost never just about finances. It's emotional and it's social. The biggest driver is the hunt for status. For so many, a fancy property is the ultimate trophy. It's a physical scorecard that tells the world you're a success. Studies show that most high-end buyers see a luxury property as a sign of their success and a reflection of who they are. It's not just a home, it's an identity. This desire for status is so powerful that it hits people at every income level. You don't have to be a billionaire to fall for it. But speaking of the rich and famous, even they get burned. Katy Perry famously lost over $1 million on a home sale after all the fees were tallied up. Actress Kate Walsh lost money on her property. Anna Paquin and Stephen Moyer took a nearly 50% loss on their custom LA home. If people with virtually unlimited money can lose a fortune, it proves that a bigger house is not a guaranteed path to wealth. It's often a path to spectacular losses. Another trap is assuming your best income year will last forever. One financial writer shared a story about how he almost made this exact mistake. After a record year, he was tempted to buy a $718,000 vacation property on top of his already expensive home. He caught himself just in time, realizing he was about to make a permanent life-altering decision based on temporary circumstances, a classic behavioral finance error. This is exactly what happened to a tech professional in Silicon Valley after his company's IPO. He took his stock market windfall and bought a $3 million house. Sure, the house appreciated over time, but the opportunity cost was devastating. If he had just left that money in the company's stock, it would have grown to between $10 and $15 million. Instead, he now faces $50,000 a year in property taxes alone, forcing both him and his wife to keep working long after they could have been financially free. He traded millions in liquid wealth for a big house that now owns him. Finally, these decisions are often driven by fear. The fear of missing out, FOMO, when the perfect house hits the market. The fear of overpaying. The fear of regret. These emotions lead to rushed decisions that have nothing to do with a rational financial plan. In fact, a study from the Urban Land Institute found that 73% of high net worth individuals admit their primary home is both a lifestyle choice and an investment. That creates a huge conflict of interest, where emotions completely cloud sound financial judgment. So, if buying a bigger house is a wealth killer, what's the alternative? How do you build real wealth without falling for the bigger is better trap? It all comes down to one simple thing: you have to completely redefine the role a house plays in your financial life. The first and most important step is this: stop viewing your primary residence as your primary investment. I'll say it again: your home is not an investment. A true investment generates cash flow, it puts money in your pocket. Your personal home does the exact opposite, it consumes cash. It's a consumption tax disguised as an investment. The real path to wealth is to keep this consumption tax as low as possible. By keeping your housing costs down, you free up your most powerful wealth-building engine, your savings rate. The money you don't pour into a bigger mortgage, higher taxes, and extra square footage is money you can put to work in assets that actually make you money, like stocks, bonds, or even rental properties. Think about it like two paths. Path A is the conventional dream: you buy the big, impressive house. Your mortgage eats up 30% or more of your income. After paying for the house and the lifestyle that goes with it, there's nothing left to invest. Your entire net worth is trapped in the walls of your house. You're one job loss or medical emergency away from financial disaster. Path B is the path to real wealth. You choose to live more modestly. Maybe you buy a smaller house or you keep renting. Your housing costs are only 15–20% of your income. You take that massive difference in cash flow and you invest it month after month. Your liquid net worth grows exponentially. You have options, you have freedom, you have security. The house doesn't own you, you own your future. This isn't about living in a tiny box, it's about being intentional. It's about consciously choosing financial freedom over social status. It's understanding that the real luxury isn't a gourmet kitchen, it's the ability to choose how you spend your time unburdened by massive debt. The ultimate status symbol isn't a McMansion, it's making work optional, a reality years or even decades ahead of schedule. The idea that a bigger house equals more wealth is one of the most destructive financial myths out there. It's an illusion that preys on our deepest needs for status and security while secretly sabotaging both. As we've seen, the real math tells a very different story. The hidden costs, the lifestyle inflation, and the massive opportunity cost can vaporize your chances of ever building real, liquid wealth. Upgrading your home doesn't build wealth, it converts your potential for wealth into a high-maintenance lifestyle asset. The key is to see your home for what it is, a place to live, not your ticket to riches. By keeping your housing costs low, you free up your money to build actual wealth. You trade the illusion of status for the reality of financial freedom. So, the next time you feel that pull to upgrade, ask yourself one simple question. Are you buying a home or are you buying a financial prison? Your answer could be worth more than $1 million.